Good morning, everyone. Welcome to this update for global stocks and commodities for the 14th of October. It's the roughest week that we've seen since the big sell-off at the start of February this year, and then prior to that in 2000 and late 2015-16. So it was a very significant week. It really came on no particular new news. The market had been well and truly aware of the trade wars and rising interest rates. I mean, it's been on the agenda now for all year. So it's it's just one of those things of the markets that eventually something triggers the selling, and the selling causes a cascade of stop losses being triggered, computer programs kicking in, and the market's largely being driven by what can be described as the electronic herd these days, because it's not the herd of people necessarily making decisions. It's the herd of all the computer programs that just do what they're programmed to do. But unfortunately, it leads to unintended consequences, and you just get this cascade of selling that feeds on itself. And of course, as I've mentioned a couple of times in this forum, there's the big unknown that's been building for probably the last 5 to 10 years, and that is this self-propelling upward spiral that's caused by a big move into ETFs over the last decade. And the process of ETFs really removes part of the process of evaluation. Stocks that are going up are bought, and that is reflected in the ETFs, which causes more buying of the stocks, which causes more buying of the ETFs, and so on. The spiral goes up, and of course, no one knows how that spiral is going to unwind when eventually the music stops. And I'm not saying that that's happening now, but eventually at some point in the future, that upward spiral will come to a very dramatic end. And I think we got a little bit of a taste of that this week. But from my perspective, the bull market is not over for all the reasons that I've been constantly talking about now for the last 3 or 4 years. And we just do not have the precursors in place that lead to a market top. And so this is going to prove to be just another one of those volatility spikes. But we're still very early in the process, and so we don't know how this is going to play out. We don't know whether this is now the bottom, or whether there is more selling to come in the next week or two. But look, I want to do my best in this edition to shed some light on that, and just give you a bit of an idea of how best to play things. So in this update, obviously, indices finally reacted to no new news. It was all out there, but there was finally a reaction. And what I want to do in this edition is to look at how this has played out in the past, and therefore how we can anticipate the next few weeks. Now, every time is slightly different, but there is some quite dramatic commonality between the sell-offs, and I want to look at the first sell-off leading into the 2008 crash. I want to look at 2011. I want to look at 2015-16, and just see what we can learn, see what happens repeatedly throughout those events, so that we're perhaps better prepared for what may come in the next few weeks and months. So that's the purpose of this edition. It'll be the normal stock and commodity trend updates. Portfolio Analyst last week, interestingly, I looked at reducing portfolio volatility while still accessing longer term growth. That was, very prescient of what happened during the week. I did look at a local high growth, low peg ratio stock. So in other words, one that's still got high growth ahead of it, but is not trading at the excessive valuations that we see with some Australian tech stocks. And it really does look poised to take off. And that, despite what's happened in this last week, is still very much the case. And I'd note that the share price of that stock did not actually move during the week. So that really underscores the value of seeking out these kind of stocks when markets get very volatile. So let's jump into it. The S&P was down a whopping 118 points for the week, 4.1%, despite a rebound on Friday night. Now, what I wrote last week was that more short-term weakness was now highly likely, and that was pretty predictive. However, I didn't expect, and I don't think anyone could have expected, the savagery of the sell-off that we saw. It's completely unpredictable, and it just comes along from time to time. It's the second big savage spike we've had this year. We may not be at the bottom yet of this decline. It's too early to tell, but markets are very heavily oversold and therefore primed to bounce. And hence, I think it's really instructive to look at the past 3 or 4 times that markets have sold off in this fashion. US dollar was lower on the week. Currency markets were remarkably stable, which was really quite interesting. So let's jump in and take a look at previous events on the S&P. Okay, so this is what I want to look at, these periods here. So this is 2008, so the first sell-off that occurred actually in July of 2007. That was, the precursor to the 2008 crash. Then I want to look at this period here, which was October 2011, and you can see that we had quite a sharp move down, and this is a weekly chart that you're looking at. And then I want to take a look at what happened in the end of 2015, 2016, so the decline there. And then also what happened at the start of this year after we had that really excessive climactic buying spell. So I want to look at each of those 4 in turn and just see what we can expect from the next few weeks or few months. Nothing longer than that. So let's go first of all to 2007. So this is in the lead up to the 2008 GFC. So you can see that we'd had a period where the S&P had hardly gone below the 200-day moving average, which is the red line. And then finally, we got a burst of volatility, which started here in July, the end of July 2007. And you can see that we got sharper falls, a much deeper pullback, and we went well below the 200-day moving average. Now just note how long this period took. So we went from the 24th of July, we had a short-term bounce that occurred on the 6th of August. We got a bounce to a lower peak. It only lasted 3 days. And then we went lower again quite significantly for another week before we got a big reversal. So that whole process, which occurred in 3 legs and was a typical ABC pattern, so the first A leg to the downside, a brief B leg to the upside, and then the final sell-off C leg to the downside. And that took from roughly the 20th of July to the 15th of August. So it took around about 4 weeks for that to play out. And then we got a significant bounce, and we actually formed a new medium-term high in October. And then we started to get some wild swings that eventually we got confirmation with the break of this low here, which occurred on the 17th of January. And that was when you could really conclude that we had a market that was probably going to go down when you start breaking these initial swing lows. But the key here is that we did get a short-term bounce, which tends to sucker people into the market. And so if we do get a short-term bounce here in the next few days, it won't necessarily signal that the coast is clear. So we just don't know at this stage. But that was 2007. Let's move on now to 2011. You can see it was a similar sort of process. We had a significant rise, and then all of a sudden we got a burst of volatility, which started on the 27th of July, and it took until the 5th of August before we got a bit of an erratic rebound. So this rebound is quite different. We got just a real washing machine of choppy action that occurred from the 8th of August, and it went through till about the 6th of October. So that took 2 months to play out. We got a marginally lower low, but that really only occurred across a 48-hour period. And then the market basically rebounded and went into the bull market that we've been in over the last 6-7 years. So bit of a different format, but nevertheless, the time span for this to fully play out was similar. It was around about a couple of months that it took to play out. And you remember too that this occurred in a period when investors were highly nervous. You know, the GFC was still a very raw emotion for many people. So not surprising that it took a little bit longer to play out. Let's move forward now to 2015-16. So we got an initial sharp sell-off in August of 2015. So we hadn't seen volatility like that in the lead up to it. Sudden breakdown. We got a significant 2-day bounce. So this is quite similar to late 2007. In this case, though, we didn't form a lower low. But again, this took from the 26th of August through to the end of September. So it took about 5 weeks. We then had a fairly meaningful bounce, and then we got another burst of it in 2016 that finished out in February. So this looks quite similar to over here. And then, of course, the market took off again. Wind forward now to February of, and just notice again on all of these, we were significantly below the 200-day moving average, and the 200-day moving average did roll over, did go into a mild decline in each of these initial cases. Now, where we are at the moment, we got a sell-off in February of this year. Looked a bit different, but it didn't ever break the 200-day moving average. So that really makes this one quite different. And at this stage, the decline we've had has broken the 200-day moving average, but it did manage to regain that on Friday night. Just managed to scramble back onto that 200-day moving average, which is it does matter. You might think that whether it's above or below the 200-day moving average doesn't really make any difference, but it does matter because it influences the trading behavior of an awful lot of big players, and it causes them to either buy or sell. So that was significant, regaining that 200-day moving average. So I think it's really 50-50 as to where we go in the next couple of days, possibly leaning more towards a bounce. But this is way too early to say whether this is played out or not. We could end up, possibly testing these February lows down here around 2,600. And so this could have several weeks to play out yet if you take the history from 2008, 2011, 2016 as any guide. But look, the bottom line is we just don't know. It's just way too early. And therefore, you really should be adopting a pretty conservative stance at this point in time because, being in the market is not a gamble. It's about participating heavily when the odds are very much in your favour. And when the odds aren't in your favour, you should pull back significantly. So that's really the key message out of this. We need quite a few more weeks yet of market action to know how this is going to play out. So that's the S&P. Let's look at the Nasdaq because that also incurred very, very heavy selling with big selling in the FANG stocks. But you can see that it actually did better on Friday night and is higher than its 200-day moving average. So despite the very sharp initial decline, you can see it occurred on very big volumes. We did get a very substantial bounce back in the Nasdaq, which is a good sign. However, a not so good sign is that the market breadth has, and I've been talking about this now for several years, how the market breadth was still very strong, the advanced decline lines were still very strong, but this is a Russell 2000, and the selling in the Russell has been more severe, and you can see that it failed to bounce back on Friday night as the larger indices did. So that's something that I'm going to be watching very closely, and that is a bit of a concern. That I don't want to see the breadth of this market narrowing. Now it's early days. This could easily pick up the reins again and charge off. But yeah, not exactly what I wanted to see on the Russell. Now the other quick chart that I want to take a look at is of course is bonds and bond yields. So let's look at this is the 10-year yield. And we looked at this last week. This is on a weekly basis. So we had a really powerful breakout. And, that initially, the stock market pretty much ignored that until later in the week. And then, of course, when stocks started to react very badly, the yield actually fell. So it got up to around 3.25 and then ended up falling back to 3.14%. So very curious action in the bond market and the currency market. All the volatility was in stocks, and of course, stocks is where a lot of less experienced players are participating. So that's the American market. Australian market didn't escape, of course. The Aussie dollar rose a little, and that was because the US dollar came off just a bit. But our market, our index plummeted nearly 300 points on the week, and it was selling across the board. A lot of the tech high flyers that had got to extremely high PE multiples, of course, they got sharply sold off in conjunction with the tech stocks in America. So they were particularly hard hit. But I did notice that resources did outperform the banks on Friday. So let's take a look at that on the Australian market. So there is the ASX 200. So a very, very nasty week and clearly back down under 6,000 points. In fact, back down under 5,900 points. There's resources sold off less and had a very nice bounce on Friday, which supports some of the things that I've talked about in Portfolio Analyst of late, and that is that we're certainly in the part of the economic cycle which is better for resources, and also in areas such as copper, for instance, we do have a supply deficit. Supply and demand deficit, which should be positive for copper, and I talked about that last week. But the heavy selling was in banks. Banks steadied on Friday, but were unable to rebound in the same way that resources did. So definitely resources outperformed. The energy sector came off, of course, but that was with the oil price coming off, which has been particularly strong. So that's the Australian market. We had a little bit of buying in the small caps on Friday, but not to any great extent. Let me just catch up with the US dollar index. So there's the US dollar index, and we'll just check on the Australian dollar. So a little bit of a bounce with the US dollar, but still clearly in downtrend, forming lower highs and lower lows. So that was the Australian market. In Turning now to commodities, precious metals, gold was up $15 to $12.19. I think peaked out around the $12.30 mark, so that was a panic-driven spike in the gold price, as you often see. And we did see a meaningful spike in GDX. Whether it follows through or not, we need more time to assess that. So let's just look at those couple of markets. So there's the spike in gold on a weekly basis. So little bit of a move, but of course it hasn't hardly retraced any of the losses of the last few months. And GDX, a little bit of a spike up and some good volumes. And there were actually some good moves in some of the global major gold stocks. But we need a lot more follow through in the precious metals market yet. Other commodities, copper rose a little, just really tracking currencies, and crude oil fell to 71.5. That was really a bit more about inventories, I think, than anything else. And the energy sector in America pretty much fell with the selling on everything else. It may fairly quickly stabilise because the oil price is, notwithstanding the fall through the week, the oil price is in quite a strong uptrend. So there's the copper chart, and there's the oil chart, which did take a big spike down. But if you pan back and look at it over 12 months, as I did last week, we're clearly in uptrend. So just to wrap it all up, this is no time to be a hero yet. Don't try and pick the bottom. If we get a couple of strong days up, you may start reading that the correction is done and dusted. I wouldn't trust it. If as we saw from the past, generally periods of 4 or 5 weeks are generally required to see this play out fully. So, don't try and be a hero too quickly. Inevitable rebounds will occur. We may get 2 or 3 days of relief next week, but it's just too early, I believe, at this stage. Being heavily in cash makes you a better decision maker at times like this, because you're not stressing about all the red all over your screen, what damage it's done to your account value in the last 24 hours. It's just such an easier place to fight from. When markets are sold off like this, quality large cap stocks, do tend to rebound. And also, as I've been focusing on in Portfolio Analyst now for a few weeks, seeking out high growth stocks, but ones that are still largely undiscovered by the market, and so they're trading on low to very modest PE ratios. And those stocks can do extremely well in these sort of circumstances because they're not on the market radar. They don't tend to get sold off, as was the case with the one that I highlighted last week. So it's just so much easier when markets are like this, just to cash up and then move forward from there. So my view is that you should have already cut significantly and quickly, and then you're in a much better position to buy on your terms. Now, Portfolio Analyst this week is going to be about market tactics and opportunities. These are really tough times to negotiate, but they're also great times to put cash to work when the decline is done and dusted. So a good time to be clear about tactics, to identify the opportunities, and that's what I'll be heavily focusing on in Portfolio Analyst from here on. There's my contact details. If for anyone that's not a member of any of my services, and I'm sure it'll be another fascinating week coming up. Cheers.